Well, thank you, Kai. Great to be here. My first time to Frankfurt. I'm obviously from Australia. It's a lovely city. Really, unexpectedly beautiful. And Kai, you're a lot taller than I thought you were when we were on the internet. So. Just wanted you to cast your mind back to February last year, 2024. Joe Biden was still the president. The gold price was about $2,000 an ounce, and the junior resources market was really decimated, use that word, particularly the Canadian TSX market. I did a tour through North America, Canada, and the US, and I had at least two people say to me, the market is never coming back. That was music to my ears. That was capitulation. And you know that when capitulation happens, that is the bottom, or very close to the bottom of the market. So since then, we've seen an almost relentless rise, and in the last 6 months, we've had a great rise. Because we know that the market is cyclical. But today, I want to talk about a different shape, not cycles. I want to talk a little bit about circles, virtuous circles, and maybe mention a little bit about vicious circles as well. I should say that I did used to be a geologist, so I probably will I may make some wild, forward-looking statements. So please, take that with a grain of salt. We've got a few handouts there. If anyone's interested in this presentation, Boyd will hand them out as a hard copy. But the things I want to talk about today are where we see the real drivers of the market, where the junior resources market is at the moment, and then these virtuous circles or vicious circles and the self-fulfilling prophecy that they involve. And then I'll talk a little bit about where we're positioning the fund for the current situation. So as mentioned, I used to be a geologist. We're really, at the fund, we're really stock pickers at heart, trying to find great value. And we really focus on, I'm sure a lot of people have seen this is the Lassonde curve, named after the famous Pierre Lassonde, with those two peaks. The first peak is for explorer when they hopefully make the big discovery. And that's where we really focus our investments at the fund, is looking for that, taking more risk, but looking for a much higher return in the mythical 10-bagger. We also do invest in that second period after hopefully the company's been through the valley of death or that orphan period. And the trick is to know when the company has made that leap and what the elements are to leaping across that valley of death. And I think one of those things we're seeing at the moment, which is making it a lot easier to do that, is this virtuous circle of higher share prices. Is that the next one? Why do we invest in explorers? It is very risky, but I would argue that actually, in some ways, it's less risky than investing in a development company. Because explorers never go broke. They might dilute themselves out the back door and they might become a shell, but they'd actually never go broke. Whereas it is very risky for a single project company to develop a new asset, which is often something they haven't done before. So you have to be very careful about which companies you invest in that are doing that at the moment. But this chart shows that it's the juniors who make the lion's share of the discoveries, and discoveries are where the real value is created. So at the fund, we love gold. We're over 50% invested in precious metals. And then in the next largest commodity we're invested in is copper. But we do everything right through to a little bit of oil and gas. And it's very interesting this year, from our perspective, that gold has really had a fantastic run. Gold share prices have done really well. But other commodities and other companies in other sectors have also done well. we've had some great wins in oil and gas. We've had a great win in manganese. We've had a great win in tungsten, for example. So it's one of the themes of this talk is it's not just about gold. It is much more broad-based than that in terms of the upswing that we've had in the last 6 to 18 months. And there's our little version of the Lassonde curve. So we take a lot more risk in the technical sense in terms of investing in grassroots explorers, and we are not at the moment in any development companies. But it's not something that we completely shy away from, and I'll talk about that a bit later on. So this is a slide that I like to show often. It just puts the markets, the commodity markets, in perspective in terms of size. So oil obviously dwarfs every other commodity, hard commodity market. It's nearly 10 times as big as the next largest market of iron ore. And then you've got gold and copper, which are the two commodities that we really like to focus on. And the reason for that, we really like to focus on gold, is because there's a lot of opportunities to invest in gold. The lion's share of junior companies are exposed to gold. And why is that? Partly because technically it's very well known how to explore for gold and how to produce gold. It's also, if you make a discovery, it's also relatively low in terms of the capital hurdle to get from an explorer to a producer. Not like having an iron ore project where you might need to build a railway in West Africa and then a port and all sorts of things, billions of dollars of capex. The capex is generally within the scope of a junior company that might have a market cap of $100 or $200 million, particularly if you can take on some debt, which is available at the moment, particularly for gold developers. Now, just a little bit about perhaps the fundamentals. Now, everyone knows a lot about the battle between the US and China for critical minerals or critical metals. Copper is one of the best examples of that, rare earths obviously as well. But what's not really acknowledged very often is the fact that the US completely dominates the oil market. And it also, in terms of central bank reserves, completely dominates gold. So here's the oil market, here's daily production of oil. The US is actually now producing more oil than it consumes. Whereas China is producing less than 5 million barrels a day, the US is producing over 20 million barrels a day, out of a total of about 100 million barrels a day. And then if you look at this chart, it shows that China is consuming 16 million barrels a day versus that means it's importing about 11 million barrels a day of oil. And that's driving a huge amount of geopolitics in our view. It's driving China to diversify its energy sources away from oil if it can. It's dominating the lithium battery market. It's building out its nuclear reactors as fast as possible, and it's come to completely dominate the copper processing industry globally, which obviously copper is required for electrification. Then turning to gold, as I mentioned, the US gold reserves, the central bank gold reserves. This is obviously what is reported, and take it perhaps as you like it. But the Chinese have about 30% of the amount of gold in their central bank gold reserves as the US does, and that is driving China to try and increase its gold reserves, and it's been underpinning the gold price for the best part of the last probably 10 years that central banks have been net buyers of gold. There's the chart showing back to actually more like 15 years, 2010, central banks have been net buyers of gold, and that's largely China. And there's another chart that people would be familiar with. China selling US treasuries, buying gold. In terms of copper, and I use this as an example of how China has come to dominate the critical minerals/metals scene. So on the left-hand side of that chart, you can see China mine production, about 8% globally. But on the right-hand side, you can see China refinery production of copper at more than 40%, and I think that's probably a lot more now. China's been building out its smelting capacity for copper at a massive rate, and that has created intense competition amongst the Chinese smelters for concentrates from the miners. And now we're seeing TCRCs, the treatment charges and refining charges, at close to zero, or in some cases it's been reported as less than zero. So the Chinese smelters are paying the miners to treat their ore and create metal for them. Obviously they get some benefits. They might get the credits from precious metals or something, or they might get the sulfuric acid, obviously, which offsets their costs. But the West has a massive decision to make at the moment. We're seeing big smelting complexes in Canada and Australia and other parts of the world saying they just can't make money anymore. They're going to close without massive government bailouts. So the West has a big decision. Do we put billions of dollars towards trying to keep our homegrown copper supply alive? Or do we roll over and let the same thing as happened to, say, rare earths happen to copper? It's a very expensive problem. And that's just the Chinese copper consumption inexorably growing over the last, well, since the stronger for longer in the early 2000s. Okay, turning to the junior resources market, and this is the Aussie perspective. So this is the Aussie Junior Resources Index over the last 25 years. You can see a couple of big spikes either side of the GFC. And then in red, I've overlaid the Canadian venture metals and mining market. Now that period sort of back in 2022, 2023, the Australian market was performing relatively a lot better than the Canadian market. And a lot of people were saying, well, oh, I think we're going quite quickly. A lot of people are saying, well, why is that? Why is Australia performing better than Canada? The capital pool in North America is obviously much, much deeper than Australia. People from offshore think that the Australians have got a massive superannuation or pension fund capital pool, but that absolutely hates investing in resources. It has to be invested in BHP and Rio, and it hates investing in anything else. They avoid it like the plague because they are overweight because they've got to follow the index. So actually the capital pool in Australia that's available for investing in junior resources is actually very shallow. So why did the Australian market perform better than the Canadian market? Well, I think it's because there's not much else in Australia to invest in. We've got a bit of property, we've got the most overvalued bank in the world, and there's not much else. So people are sort of forced by default to invest in resources. But it's mainly retail and family office money in my view. So this is perhaps the key slide in my presentation. It shows the Aussie Junior Resources Index in yellow versus the US Fed funds rate. And you can see a very strong inverse correlation between the two. When US Fed funds are falling, that's very good for junior resources. It's very good for other speculative investments which don't pay a yield. It's good for gold, of course, which doesn't pay a yield either. But when Fed funds rates are rising, you can see that the junior resources market starts falling. So that's very important in terms of, for investors in junior resources, to take a view on what you think the Fed funds rate is going to do. And to paraphrase Bill Clinton, it's the Fed, stupid. There's the outlook from back in September for the US Fed funds falling from about 3.75, I think it is at the moment, down to around 3% over next year. And that's obviously changing quite a bit. But that, if that occurs and we see the Fed funds rate come down to 3% over the next 12 months, that will be very positive for junior resources and gold. The other question we have at the moment, is why are all these asset classes performing well together? Normally you wouldn't expect gold and copper to be performing well at the same time. You wouldn't expect The S&P 500 would be hitting all-time highs at the same time as gold. Real estate prices in Australia are at record highs. Why is that happening? So this is probably the next most important slide. In my view, it's been attributed to this $1.5 trillion US of excess liquidity. So that's, in the long run, significantly above what you would have interpreted. That line is the dotted line from the Rockefeller Institute. They're saying that that 1.5 trillion number is a number that's in the US money market managers' investments. And that money is looking to find a return. And when you've got low interest rates, that money will go elsewhere. It'll go into Nvidia, it'll go into Apple, and a little trickle of it will go into resources. In terms of gold, this is what we think the key factors are. When interest rates are coming down, as mentioned, when liquidity is going up, and the other boost, of course, is the de-dollarisation, which really sort of kicked off at the start of the Ukraine war, when we saw China and other non-Western banks, central banks, looking to increase their gold holdings. In terms of commodities, this is the last 12 months. You can see that specialty metals like tungsten, cobalt have done very well, and also, of course, precious metals. The laggards have been energy, largely. There's coal, there's oil, there's gas down the bottom on the left-hand side. So that is potentially a counter-cyclical opportunity for investors. In terms of share prices, this is Australian Stock Exchange resources companies divided up by the commodity that they're focused on and how their share prices have performed over the last 12 months. So it matches quite well the commodities, the underlying commodities themselves. Cobalt, tin, tungsten have done the best. Coal, oil and gas are down there on the left-hand side. Iron ore as well. So for junior resources investors, this is, I think, an important slide. This is the Australian market in resources broken up by market cap. In the last 12 months, the biggest quartile by market cap is up 124%. In that period, the nano caps, the real tiny companies with the market cap of less than $11 million, is actually down 7%. But if you look at the last 6 or 3 months, you can see that really bottom end, penny dreadful end of the market has been performing better. And I think that can be attributed to the trickle-down effect. The initial money goes in at the top in the bigger companies, and eventually it trickles down. And part of that is due to the potential for M&A as the big companies make more money. The producers, certainly in the gold sector, are making a lot of money, and they're looking at what they're going to do with that cash. Oops. So here's just a snapshot of the fund's top 10 positions. You can see gold's pretty strong there. We've also got some rare earths. We've got a bit of silver and manganese and a bit of copper in there. But what I want to point out with this slide is that column, or those 2 columns in yellow. And this is very important for junior resources and junior resource investing. You can see the PNAV. It's a metric that is very popular in North America, not so popular in Australia. But you can see those PNAVs are around 0.1 to 0.05, sorry. So, if those companies were to achieve the underlying value of their projects on NPV basis, they would be 10 baggers, theoretically. And I've used roughly current gold prices, which is in Australian dollars about $6,000 an ounce. You notice Medallion Metals there is trading at 0.3. Paul Bennett, the MD, tells me that's a bit high, and it should be a little bit lower in terms of there's more value to be captured there. But if you look at the column on the right-hand side of those 2 yellow ones, I've divided the market cap by the potential capex of each project, and this is super important for companies that are looking to make the leap from exploration or resource drill out into development and need to raise substantial capital. So if you've got a ratio there of around about 0.5, that means, assuming you can get 50% debt for your project, you only need to raise your market cap to provide the equity for that project, which is potentially doable. And you can see Medallion Metals there. They're trading on a 4 times market cap to capital requirement, their headline capital requirement, roughly. And they've actually announced that they've got the lion's share of that capital in the bag. So that's why they're trading at a relatively higher PNAV than some of these others on that table. So I mentioned talking about circles. There's 2 sorts of circles in junior resources. There's the vicious circle, which we endured for a long time, for many years from 2015, where share prices fell, made it harder to raise money. As a result, it was less likely that these companies could fund their exploration or development programs, and then the share price fell again. And so you were really in a really difficult situation, and you had to try and get yourself up by your bootstraps. Whereas now, we've seen a real upswing in a big part of the market. Share prices are rising, easier to raise money. It means it's easier to fund your programs, whether that's an exploration program where you're going to go out and find hopefully some new resources, or you're going to put your project into development. And you get the double whammy with the higher metal prices. Your cash flows from development are higher, and the likelihood of achieving those cash flows is higher. So it's a virtuous, what I call a virtuous circle, and that's the situation we're in at the moment, in large part. I won't go through this. This is just our activity over the month of October, things that we added to the fund. You can see there's a lot of gold added there. But you can also see, the market caps are relatively low on the companies that we like to enter into. And then we like to exit, when the market caps are, in the billions, hopefully. I won't dwell on this. This is gold bull cycles over the last 50 years. You can see we're about halfway to the big bull cycle of the late 70s. Just to finish off, talking about the money that gold producers are making at the moment. This is the Australian listed gold producer index put together by Euros. You can see the black line is the Australian dollar gold price, and the blue bars are the corporate all-in costs, which means every single thing that these companies spend, including marketing, including buying back their hedge book, including making acquisitions, etc. You can see both those have moved up, but the margin has definitely opened up, and these producers are making a lot of money. Part of the reason for that, just as a small digression, is the oil price. This is the oil price, inflation adjusted over the last 20 years. You can see generally it's on a slight downward trend. With oil or energy costs being about 30% of most miners' operating costs, this is really significant for the margin that those guys are making. It's also very important, in my view, to keep a bit of a lid on inflation generally, and perhaps that's why inflation is still being relatively moderate in the US. Just a chart of the cash that Australian gold producers are sitting on. The standout is a company called Virtuous with about $1 billion US of cash in its kitty. The things that they're doing with those, they've largely already bought back all their hedge books. They're reluctantly paying special dividends and buybacks to shareholders. They're expanding their mining operations in some cases, but largely they're sitting on their cash, and M&A is something that I think is really latent in the sector. Okay, I'm going to finish it there. Just a little plug. We do a webinar. We interview successful geologists who made big discoveries. So if you're interested, please have a look out for that on YouTube. But I think I'm just about out of time. I think I've got 3 minutes for questions if anyone would like to ask one. So thank you.
Go back to slide 7.
Oh, all the way back. Well, that's. Has anyone got another question while I get there? Is there easy?
Are you a value or growth investor? What do you prefer from the companies? Do you prefer a special dividend or dividends, or do you want to see them reinvest the money?
I think we're very much an exploration focus. We like to see the exploration upside. So we're probably on the side of reinvestment. Where if someone pays us a dividend, we don't really know what to do with it. So nearly there. Is that the one?
Yeah, I'm just curious how you define those different companies in there.
Yeah.
You say you don't invest in a development company. What's an example of one?
A development company is someone who's building a project right now. So they're spending cash to build their mine or whatever. So it's hopefully a fairly short window. Might be 1 or 2 years that a company is in development. But not to say we don't invest in those stages, but we're pretty wary about it because that's where companies can come unstuck. Yep.
Well, and I assume it's because you're trying to avoid the trough of the Lassonde curve, but most companies are trying to work around that now. I think Vizsla Silver is a good example. They're developing a mine, but they're doing a huge amount of exploration.
Yeah, that's the secret. Make the market look at the exploration and not the the issues that might be there in the development. Yep.
We get time for more questions.
Yeah, I'll go.
Tom.
Thanks, John. Portfolio construction. I saw a lot of gold, energy, one rare earth company. Are you constructing on any metals? Do you think about how you construct a portfolio?
Oh, 100%. So, we do have a bit of energy, and we've just sold out of a really nice position there, so it has come down. But we're definitely looking hard at increasing our energy exposure at the moment. We are, sort of those specialty metals. We do like to invest in them. Tungsten's been really good for the fund recently, but there's just not that many opportunities, Tom. Gold is what walks in the door every day of the week in terms of opportunities. I hadn't seen a zircon project come through the door, for example, for, 5 years. But then all of a sudden there was 5 zircon projects that came to see me, in the last couple of months. So it is sort of a opportunity versus, desire sort of thing.
Fantastic.